Good afternoon. I'm Ward Keever, founder and CEO of Covenant Wealth Strategies, and I'm joined this afternoon by Michelle Fisher, part of our leadership team. Today is Wednesday, January 31st, 2024, and we welcome you to the latest installment of our Stone Barn Speaker Series. This obviously will be a virtual Stone Barn Speaker Series, and our program today is the 2024 Market Outlook. We are honored to be joined by Meera Pandit and Brittany Wells from JP Morgan. And Brittany Wells is a relationship manager who helps to facilitate our Covenant Wealth Strategies relationship with JP Morgan. Meera Pandit is a managing director with JP Morgan and will be our featured speaker today. A little bit of background on Meera. She is a global market strategist on the JP Morgan Asset Management team. She is responsible for delivering timely and relevant market and economic insights for institutional and retail clients, as well as conducting research on the global economy and capital markets and running economic forecasts. She is responsible for publications, including the JP Morgan Guide to the Markets, which is what the presentation today will be coming from a lot of the Guide to the Market charts. Meera joined JP Morgan in 2011 in JP Morgan's private bank in New York, where she served ultra high net worth clients, and has also worked in London as well as New York. She earned a BA in English from Tufts University and is also a CFA, Chartered Financial Analyst charter holder. Personally, Meera and her husband live in New York, and they have big news. They're expecting their first family expansion project. Their first baby is on the way come April. So congratulations to Meera and her husband. Meera, without further ado, let me turn it over to you. We will be doing questions at the end, and I think we'll have questions will be emailed to Michelle at Covenant Wealth Strategies. So those will come right in here to Michelle. We'll hold questions until the end. And Meera, once your presentation is completed, we'll engage in some Q&A back and forth. All righty.
Great. Thank you so much. Thank you all for having me today. It's definitely a busy week in markets and the economy. We had the Federal Reserve meeting today and speaking a little bit about the future of interest rates. We also had a number of reportings from an earnings perspective from different technology companies, not only yesterday, some today, some tomorrow. So a lot of economic data coming in. But today is not for talking about the headlines. It's for talking about the broader outlook. And for the economy this year, actually, if we go back a slide, we expect a 2024 economy, maybe back to the cover. We expect a 2024 economy in 2024. So what does that mean? We expect 2% real GDP growth, which is in line with long-term averages. We're coming off of a very strong base for economic growth. Zero recessions. It is not our base case that we're going to see a recession last year because the economy, again, is coming off of such a strong year and is in pretty good shape. 2% inflation. The Fed is targeting 2% inflation. We're at just above 3%, but we do think we can get down to 2% this year. And around 4%, maybe slightly below that, unemployment, which is, again, roughly where we're at today. So it's a pretty benign economic outlook overall, kind of a normal economy, quote unquote. So hopefully that should bode well for markets overall. So if we flip a few slides ahead to the 2-0 part, the 2% growth and the zero recessions, what you can see on this slide here on the left is real GDP growth over time, the growth of our economy in real terms. And on average, the economy grows about 2%. Now, for the last 6 consecutive quarters, the economy has grown well above 2%. So we've had an unusually strong economy. And despite thinking we were going to go into recession last year, we actually had an economy that was not only resilient, but actually reaccelerated. The strongest 2 quarters were actually the most recent. So overall, we would expect that the economy kind of gradually gets back to a normal pace, but not necessarily negative growth or a recession, not with the data we have on hand. That doesn't mean some sort of exogenous shock couldn't come into play and bring a recession upon us, but it is definitely not our base case given the strength that we're seeing. So what made the economy so strong last year? Well, if you look at the chart on the right, we look at the components of GDP, essentially what drives the economy. And 2/3 of the overall economy is consumption. And you saw that consumers continued to spend. Perhaps we'll see a little bit less of that than last year, but nonetheless, consumers are in reasonably good shape. You also saw in gray businesses continue to spend, which is kind of unusual considering the fact that we had a regional banking crisis last year. But you saw businesses spend on things like AI and productivity enhancing labor saving tools. You also saw that that businesses spent on some of the various government subsidies that we have, from the CHIPS Act to the IRA, with that uptick in manufacturing spend. The government spent $300 billion more last year than the prior year. So in the long term, that's probably going to be a challenge for both growth and inflation. But in the short term, that did help to boost spending overall. So everyone was spending: consumers, businesses, the government. We again expect a little bit less of that this year than last year, getting closer to that 2% pace of growth. So slowing off of a very high base, essentially. Now, if we think about why we were able to avoid a recession last year, a number of different things at play here, but I think the core reason is the fact that people had jobs and people could have incomes that supported their lifestyles and their spending. So if we look at the next slide, what you can see here is the unemployment rate over time in gray, and then wage growth today versus 1 year ago in blue. And from an unemployment perspective, the unemployment rate is about 3.7%. So we've actually spent the longest stretch at or below 4% since the late 1960s, which means not only is unemployment low, but it's also actually reasonably stable there at this point. Now, in addition to that, if you look at wages, that's today versus 1 year ago, you can see how high wage growth was in 2022 and into 2023. It's kind of plateauing at a higher level, just above 4%. But remember that inflation at this point is below wage growth, which means that actual incomes, what people are bringing in, the increase in what they're bringing in relative to the increase in their cost of living, is in much better balance than it has been when inflation was actually beating wage growth for a period of time there. So people have jobs, and people actually might be getting more money on a real basis relative to inflation than they were in the past. So that is really the key when 2/3 of your economy is consumption, to having a reasonably healthy growth backdrop. Now, of course, inflation is still on people's minds if we take a look at the next slide, but it's made a lot of progress. It is down, but it is not out. But again, we think we can get closer to the Fed's 2% inflation target. So what you can see on this slide here is headline CPI in blue, which is a broad measure of prices across the economy, and core CPI in gray, which is essentially X food and energy, because they tend to be just a little bit more volatile there. And what you can see there is inflation was at almost 9% in June of 2022, and now it's slightly above 3%. Now, if I think about the road we've been on, the path from 9% to 3% is actually easier than the path from 3% to 2%. It's kind of like, for those of you who have set New Year's resolutions or maybe already given up on them, for those of us who set some weight loss targets, getting from 9% to 3% is like losing the first 15 pounds. The 3% to 2% is losing the last 5, which can sometimes be the hardest, because we've already made the easy progress. We have seen commodity prices normalize. We have seen supply chain issues normalize. Hopefully people are getting the things they're ordering on time at this point without too much cost pressure there. And goods are actually coming down in prices because people don't want the laundry machines or the Pelotons or any of the big ticket items anymore. They're really geared towards services. And actually 80% of the remaining inflation is coming from two categories: rents and auto insurance. So two areas that actually are deeply lagging in terms of the way that they're calculated and very concentrated. Because if you looked at 2 years ago, you had inflation coming from every corner of the economy. So the fact that it's only lingering in a few areas that tends to be a little bit lagging in nature in terms of when they start to show improvement, I think is a good thing, because it means we've drained a lot of the excess inflation from the economy. Now, remember that inflation slowing and coming down to the Fed's 2% target doesn't mean a reset in prices. We're not going to see the prices that we saw before the pandemic. The prices have reset at a higher level, but the price increases from here on out are likely to be a lot more gradual. So if we put this together, a reasonably strong economy that is slowing back to trend, a labor market that is normalizing, and inflation that is making progress towards the Fed's 2% target. If we take a look at the next slide, essentially that gives the Fed, our central bank, the ammunition to think about not only stopping hiking rates, but actually cutting rates. And this is a huge departure from everything that the Fed said last year. They were very much higher for longer. We don't want to cut rates until the economy looks pretty bleak. And then they really pivoted pretty dramatically at the end of last year to say, actually, we're open to cutting rates. And yet there's a big divergence between what the Fed thinks will happen and what the market thinks will happen. So this slide in gray looks at the federal funds rate, that benchmark policy rate over time. And then in blue, it's year-end expectations going forward of where the Fed sees the federal funds rate relative to the market expectations in green. Now, the Fed only puts out expectations on a quarterly basis. So as of December, they said, we think the federal funds rate is going to go down to about 4.6% by the end of 2024, which implies 3 rate cuts of about a quarter point each. Now, the market, on the other hand, was pricing in way more than that. If you look at this slide here and you look at that first green diamond, as of December 31st, they were pricing in a year-end federal funds rate of 3.6%. That has since risen to about 4%. So the market and the market is kind of migrating more in line with the Fed. And we would agree with what the Fed is seeing for this year. Inflation's making progress, but it's not dropping like a stone. So they can cut rates, but they don't need to cut rates that fast, because they do get a little bit worried that inflation could be sticky, and rather than reaccelerate, just kind of stay where it is. So they want to be a little bit more gradual about this process. And this afternoon, when we heard from the Federal Reserve and the Fed Chair, Jay Powell, he really expressed an emphasis on wanting to be a bit more patient with the data, wanting to make sure they were absolutely sure that inflation was on the right trajectory before they started cutting rates. They had the luxury of a strong economy and inflation coming down to kind of wait a little bit more. And so it is likely that they're going to cut less and later than the market expects. And over time, the market will kind of come into line with that expectation. But overall, it's really a question of when, not if, the Federal Reserve cuts. We don't think that they're going to cut rates in March, but we do think that probably May or June timeframe, they start to think about those rate cuts. Now, that is what is happening from a monetary policy perspective, but that has a huge implication on what then happens in the markets. So if we take a look at the next slide, there are kind of a million and one stats about what happens after the Fed pauses, what happens when the Fed starts cutting rates. You know, I think a picture is worth 1,000 words, and so I've got 2 of them here for you. And one of them on the left looks at 12 months before and 24 months after the final rate hike from the Fed, and what returns looked like in the S&P 500 relative to what returns looked like in the bond market. And what you can see here is that although it felt like bonds did really well at the end of last year and had a huge drop in rates, which is positive for the bond markets, and although it feels like the S&P did extraordinarily well last year where it did, we could actually still be in the early innings of a rally. Now, I would characterize that rally going forward as something that's a little bit more steady eddy, not necessarily the double-digit gains that we experienced before, but things could grind a bit higher. Because again, the economy is looking like it's on solid footing. profit growth, when we think about company earnings, is also looking like it's about to turn a corner. And if we think about what has already happened, again, we actually haven't seen markets race to the top as furiously as we had seen in the past, or not very different than what we had seen in the past. Because if you look at the red line of where we are today, after the last hike, which was back in July, you actually saw markets retreat, both on stocks and bonds on the left and the right. And I think that the reason for that was that nobody knew that the Fed paused, or nobody knew that the Fed wasn't going to raise rates more. The Fed didn't really say that they weren't going to raise rates more. So essentially then what you had to wait on was the Fed to actually say by November, which they did, we're not going to raise rates further. And so then you start to see this turnaround in markets. But again, you're still far away from some of those other prior experiences. So we could be in still the early innings of a rally here in both stocks and bonds, just again, expected to be a little bit more gradual. So how do we think about that on first the bond side and then the stock side? If you look at the next slide, just to kind of put some of the bond returns in context, because we had some pretty rotten years. We almost had 3 down years in a row in the bond market. And yet last year, because rates dropped so suddenly and so sharply at the end of the year, you actually had a 5.5% return in bonds overall. So this chart looks at returns in a broad index of bonds each calendar year, but also the maximum the market fell from a bond perspective in that year. So usually the bond market declines about 3 or 4% on average each year. But clearly 2022 was a huge outlier where we saw double-digit declines in the bond market. And last year we saw a recovery, even though it was very volatile in the bond market. You did see that one, rates fell, so bond prices rose. And you also saw that finally you're picking up some pretty decent coupon in the bond market. Income has been something that's been relatively scarce for many years since the financial crisis, because we had 0% interest rates. Now income is back. And you don't always have to take on a whole lot of interest rate risk, whether rates rise or fall. When you're investing in the bond market, you can be somewhat shorter on that interest rate risk so that you're getting the benefit of the coupon and the income without necessarily taking on as much of the market risk. So there are definitely places in the bond market to continue to actually do what bonds are supposed to be best at doing, which is garnering income for portfolios. Now, on the stock market side, if we take a look at the next slide, although we had amazing returns last year, they were very skewed towards a small number of stocks. So I'm sure you've heard of the Magnificent Seven, the big mega cap tech companies. What we've looked at on this slide here is actually the top 10 companies in the stock market, which include those 7 stocks. And what you can see on the left is that those top 10 stocks essentially were accounting for 86% of the returns in the stock market last year. So they were up 62%, whereas the rest of the market outside of those stocks was up 8%. And that's how you got a blended return for the index of about 24%. So the performance was very lopsided, but also that means valuations have become very lopsided. So how cheap or expensive stocks are, it is no longer something that is in balance across the index. Those top 10 stocks are about 38% more expensive than the rest of the market. And in fact, some of the rally that we've seen just in the last couple of weeks since December 31st has made that valuation gap get even more extreme, where the top 10 stocks are 50% more expensive than the S&P as a whole. So you have this distortion in terms of valuations where these stocks have become very expensive. The challenge there is some of these higher valuations are more vulnerable to correction. And then you also have this concentration issue, which is quite unusual. The weight of the top 10 stocks on that right-hand chart there is about 1/3 of the overall index. So just those 10 stocks are 1/3 of the index and only contribute about 20% of the profits. Ideally, you want those numbers to be pretty commensurate. Because they are not, that is a little bit of a challenge there, where those stocks are not necessarily pulling their weight. So when we think about allocating to equities, although it can be very distracting when you have a very small number of stocks producing some outsized returns, but don't forget about 2022 when those stocks did miserably and the rest of the market did much better. It's about finding a good amount of balance and diversification within portfolios so that you don't experience as much volatility. Now, one area of the portfolio where clients have been particularly fond of has been cash. If we look at the next slide, it's pretty hard to resist a 5% return on a CD when it feels like bonds have been pretty volatile, the outlook for stocks has been somewhat uncertain, and yet there's a huge opportunity cost to hiding out in too much cash. So what you can see here is the peak CD rate, the highest CD rates got during prior Fed hiking cycles. And then 12 months later, what the return would have been in those CDs in gray, in aggregate bonds in blue, in the stock market in green, and in a 60-40 balanced portfolio in lighter blue. And what goes up often comes down. So the peak CD rate usually coincides with the highest, the Fed is hiking rates and the highest yields get. And so usually after that, they fall. And then what happens is, as you roll that CD, you have that reinvestment risk where your income becomes less and less and less. On the other hand, with bonds, you're able to lock in a higher level of income for longer. And then as yields come down, you actually benefit because yields fall, bond prices rise. So you get some of that capital appreciation. So that's why you've seen in every period where the Fed was raising rates in the past, bonds have outperformed cash. And in 5 out of those 6 periods, the S&P 500 and a balanced portfolio have also outperformed cash. Now, this is historical data. This is a somewhat theoretical point. But if we take a look at the next slide, this is already playing out in terms of where we're seeing markets today. So if we move one slide forward, what we can see on this slide here is a top to bottom ranking of different asset classes within a portfolio from 2008 all the way to 2023. And if we look all the way to the right in 2023, you can see that towards the bottom of the chart there in purple, cash returned 5.1% last year. Pretty impressive return. It was actually the best return that cash has seen since the year 2000. So 25 years ago, good. And yet, if you look at everything else that comes above it, there was a huge opportunity cost to being in cash because everything else essentially did better. Again, bonds were negative for most of last year, but eked out a return just above cash. And if you look at equities, whether it's large cap, small cap, international, emerging market, all of those areas did better as well. And that's why cash can be a real kind of silent killer of a portfolio, because while you feel good month after month, week after week, kind of seeing your statements and thinking things look pretty good and you're getting income and you're beating inflation, the bigger risk in the long run is shortfall risk, that you're not growing your portfolio enough, that you're missing the 25% years in the S&P 500 and therefore may fall short of reaching your longer term investment goals at the end of your investment time horizon. By which time, when you realize it, then it's a little bit too late to kind of make that up. So despite that enthusiasm around cash, it underperformed, and it's not maybe the safe haven for a longer term investor that we might think it is, especially when you look at that white box there that looks at asset allocation or a diversified portfolio. It's a combination of essentially everything on this chart here. That was up 14.1% last year. So it did help to capture returns on the upside, but also protect on the downside to deliver a bit of a smoother kind of quote unquote, what felt a little bit steadier ride going through a year that was still very uncertain and volatile for markets, but again, protected from a portfolio standpoint. So with that, that is the end of my prepared comments, but happy to take some questions.
Meera, while if you want to, Brittany, move it to that next slide, so it just gives the email address for Michelle. And actually, we do need to pause here on. Oh, there you go. That's fine. We can go back at the end and pause on the disclosures for compliance purposes. So while we're waiting for some questions to queue up, a couple of things that I wanted to ask you about. I mean, thank you very much for your presentation, and I think. Our Covenant Wealth Strategies investment team is very much aligned with the JP Morgan outlook. So a couple of questions that I might offer to you. talk about recession. There's a lot of people out there, a lot of respected voices that have been calling for a recession. It seems like for months, if not years. Uh, they always just seem to be right over the next hill. We're going to have a recession. And then we get to that hill and there's no recession. And it's over the next hill. But then we get there and there's no recession. So why do you think there's such a disparity between so many respected voices that are calling for a recession and your JP Morgan team, and I would say also our Covenant team that doesn't see a recession in the near future?
So if we look at history and what has caused a lot of recessions, in particular, one of the big causes of recession is that the Fed hikes rates too much, they over tighten, and actually that ends up slowing economic growth. And so the Fed has actually been a contributor to many recessions in the past. And so the Fed hiked rates this time around from 2022 to middle of last year, the fastest it essentially ever has. And we also came off of a really low base of 0% rates. And we existed at 0% rates for about 10 or 15 years effectively, even with a small rate hiking cycle that essentially hit the skids halfway through what we have experienced this time around, less than half. So essentially, there was some fear that, wow, the Fed has really done it this time. In order to control inflation, they're going to push us into recession. And think about where we were coming into last year. Coming off of the Fed rate hikes, not getting any more expected fiscal stimulus. We expected the consumer to slow down. You come into the first couple of weeks of the year and you have a regional banking crisis where it feels like, wow, okay, this is the impact of Fed rate hikes and something is breaking. Because the last time we had a banking crisis was the financial crisis. So it's not unusual to expect, wow, things could be pretty bad. It is unusual to expect that the Fed hikes rates 125 basis points and the economy actually grows faster. So I think what we have to keep in mind is that some of the policy moves over the last couple of years have been distorting factors. When you think about the pandemic, essentially 25% of GDP was plowed into the economy. Compare that stimulus to what you saw after the financial crisis, it was like 5 or 6%. So it's almost like we had enough stimulus for both the last recession and the next one. So there's a couple of different distorting factors that have defied everything we know about history when we think about a lot of the indicators that point to recessions. An inverted yield curve. There's an indicator called the Leading Economic Indicators Index that has spent essentially its longest period of time negative without seeing a recession. So I think it's a big lesson in kind of defying expectations and defying a lot of economic logic and historical experiences. And you know, in addition to that, I think it just reminds us as investors that we focus so much on the downside risks that we forget that sometimes there's upside risk where things actually kind of go right despite a lot of noise in a given year.
I've heard it said that we've never had a recession with unemployment below 5%. And as you mentioned, unemployment is currently at 3.7%. Generally speaking, recession is loosely defined as 2 consecutive quarters of negative GDP. And you pointed out that roughly 2/3 of GDP is consumer spending. And I really appreciated how you tied in employment to consumer spending, because I think that that's a critical thing, is that if 2/3 of the GDP is consumer spending, and if consumers have jobs, they'll spend. So our perspective has been and continues to be, as long as unemployment is under 5% and certainly under 4%, we just don't see a recession happening because consumers are employed and they will spend money when they're employed. Meera, let me come back to a question relating to that. What are your thoughts on this whole onshoring, reshoring phenomenon in terms of, we went through the pandemic, we realized our supply chains were maybe vulnerable, and there seems to be a lot of talk about onshoring or reshoring, whether it's pharmaceutical or steel or different things that we're bringing supply chains, chips. I think we've got 2 chips factories being built in the Midwest, and Intel is building up in Ohio. Speak to a little bit this idea of onshoring and reshoring, and maybe how that's structurally helping to maintain employment at low levels, unemployment at low levels.
So, I think that ultimately the unemployment at low levels is really driven by the fact that our demographics are changing in terms of aging population, boomers aging out of the workforce. Although immigration has picked back up for a while, it was lower, so you had less of a valve of people kind of coming in. So I think we're just structurally in a place where essentially labor demand versus the actual supply of labor that we have is in an imbalance. So that is really kind of keeping unemployment low. When I think about nearshoring, friendshoring, onshoring, whatever you want to call it, look, it is happening on the margins. The challenge is that because wages have risen, it just tends to be more expensive to do some of that onshore than it does offshore. That being said, after the supply chain issues of the pandemic, people got a little bit spooked by that, and companies said, I need to make sure that I have some dependable sources here and wanting to move things to different places. Some of that moved onshore, but a lot of the onshoring back to the US is sort of the high, more advanced manufacturing, but you're also seeing supply chains reroute to different places in Southeast Asia, to Mexico. So a lot of these different economies are actually big beneficiaries of that, which means their equity markets and their economies can be big beneficiaries as well when we think about international investing alongside of that.
Great, thank you. What if you could speak a little bit to housing, because you spoke about inflation and specifically shelter costs or maybe rents. I'm not sure if we're using those two terms interchangeably. So to the extent that inflation is sticky, and you said 80% of inflation right now is rents and auto insurance, if you could speak a little bit to housing. A lot of times housing historically has kind of led us into recession. In this particular instance, it seems that housing is helping to keep us out of recession. You've got kind of a little counterintuitive with the Fed raising interest rates. People who have 2 and 3% mortgages don't want to sell their house to go get a 6 or 7 or 8% mortgage. So it almost seems like the only game in town is new construction, and therefore housing and the jobs related to it and everything else seem to be acting as a buoy to this economy.
Right. I mean, the big difference you see now, to your point, between today and the financial crisis, which was also the housing bubble, is that there was so much overbuilding in terms of housing at that point. And this time around, there hasn't been. Actually, in a reaction to that, you've seen many years of underbuilding. So we actually are left with a low amount of housing stock and a low amount of inventory. So all of a sudden during the pandemic, when that dynamic really started to shift, when all of a sudden you had a lot of first-time home buyers coming to market, again, and people wanting to buy homes, you just didn't have enough supply. So if the supply is so constrained and the demand is higher, that's just going to keep prices at a reasonable level, even once rates went up. And then to your point, people don't necessarily want to move out of their house at 6% or 8% mortgages. So essentially that makes that problem even more acute. So I don't think we see a housing collapse simply because there's still a lot of demand and not enough supply. And it will take a few years to really get that supply back up to a reasonable level where you start to see those two things match a little bit better.
So two things that we've spoken about, Meera, one being employment and the other being housing. And those are two big factors in terms of an economy that's expanding versus an economy that's going into recession. Do you see either of those factors changing in the near future? They seem rather structural to us. That is to say, the supply-demand dynamics of both employment as well as housing. They seem to be kind of structural or enduring that should last for some period of time to help to underpin the economy.
The housing feels a little bit more structural, but actually, I do want to point out that if you look at housing as a share of GDP, we had it on the first slide there, it is such a small sliver of the economy. It feels like it's a lot bigger because there's a lot of ancillary growth that comes from when you buy a house and you're filling it with furniture and you're outfitting it and the services that are used to build the house. But actual residential construction is a pretty small part of the economy. Again, it's really all about the consumer. And from an employment perspective, yes, there are some real structural underpinnings of a strong labor market. But remember, when times get tough, businesses are able to shed workers. And so we do want to be mindful that even if structurally there are factors that can hold unemployment lower, There are ebbs and flows within the economy that, when it comes push to shove and profits are under threat, you do tend to see businesses lay off. And you have seen a number of layoff announcements as companies are trying to manage their costs. But you're also seeing actually a decent amount of labor hoarding where people are like, that's the last thing I want to cut because I actually couldn't find the right workers for so long that I want to keep the people I have. So maybe during the next recession, you don't see as high of a spike in unemployment, and you see that unemployment comes down a lot more quickly than it has in prior recessions. But nonetheless, I don't think we can avoid seeing challenges in the labor market if the economy is under pressure. It just doesn't appear to us that it will necessarily be under pressure this year.
My understanding, Meera, is that at its peak, we had 2 job openings for every unemployed person in the country. And more recently, that's come down to 1.4, but we still have more job openings than we have unemployed people in the country. So even as companies are maybe laying some off, and we've seen some announcements even this week, it would seem that the job prospects are still pretty strong in the economy out there.
Overall, I mean, look, I think that the openings have been just so much higher than they have been historically. So even as they've come down a little bit, there's still a lot of jobs out there. Look, I don't know that necessarily there is, any of those, all of those openings are genuine. I do think that companies are really looking for the right candidates. And if you look at other data looking at quits, fewer people are quitting their jobs, fewer hires are taking place, but still those statistics look much better relative to long-term averages. So I actually don't think that's necessarily a bad thing. I think it just means that the supply and demand dynamics in the labor market are improving, because it's less so that every one available worker is under such hot competition that it's going to push up wages and create some real challenges there. So I don't think that the job market cooling off a little bit is a bad thing. It's still in a pretty good place, especially when you look at long-term history.
We've had some questions come in. One question I wanted to present for you was, in your presentation, you did not really speak to anything pertaining to international investing. So whether developed markets or emerging markets or that sort of thing, what is your outlook, or what is JP Morgan's outlook as it pertains to international investing versus domestic?
I think that international investing can be competitive with investing in the U.S., especially because some of the dynamics structurally have changed internationally, where for a long time, think about places like Europe and Japan having negative interest rate policy. Europe has firmly positive interest rates at this point. Japan is going to get there. It'll be slow and steady. And you have a lot of countries around the world spending from a fiscal perspective. It's not just the US, but both emerging and developed economies are putting money into their infrastructure, digital, physical, into energy transition, all sorts of different things. So that also helps from that perspective, because some of the international exposure is quite cyclical in nature, whereas everything that worked over the last 10 to 15 years was really just tech. So I think you can see a broadening out, not only in the US stock market, but internationally because of some of those characteristics. I would say areas like China and Europe, from a growth perspective, look like they might be a little bit slower and a little bit more challenged this year. Whereas areas like India, Japan, we're seeing a lot of opportunities from an equity market perspective. And from, in the case of India, some of their longer term growth and workforce dynamics. And in the case of Japan, some of the corporate reforms that they have underway that are supporting stocks there. So I think it's about picking the right spots within international, and even within that, the right themes. So you tend to see things like within Europe, even if the index as a whole might struggle with growth, things like luxury goods, renewables, biotech there have done very well over the last couple of years. So really thinking about some of the themes that have worked and we expect to continue to work as a way of narrowing the field within international equities, it is definitely an area where you want to be pretty active on stock selection.
And certainly there are, per se, broad markets, acknowledging what you just said. It seems as though there have been a very consistent year after year after year where international markets have underperformed domestic markets. When do you, I mean, would you agree with that statement? And when would you think we might see that reverse?
So, again, I think that given some of the things I mentioned on fiscal and interest rate policy, you're starting to see some of those structural shifts underway. I don't necessarily think that means that international outperforms the US, but again, I think things start to become a little bit more competitive. And when we think about the US markets being as concentrated as they are, and the leadership and the valuations being as concentrated as they are, and we want to have reasonable portfolio diversification, having international stocks that become a little bit more competitive with the US, I think could be an important source of diversification, even if it's not a massive level of outperformance, but it's kind of keeping pace.
Thank you. Another question that came in, Brittany, if you can go back to the slide that talks about the top 10 stocks versus the other 490 stocks. The question that came in, and Meera, if I could ask you to maybe unpack this a little bit more. And I think one thing that might be helpful here is to maybe define or explain how the S&P is constituted in terms of the capitalization or cap weighting. So if I could maybe ask you just to speak to the difference between, for example, the S&P 500 versus an RSP equal weight index, and just spend a little bit more time explaining how 10 stocks can have such an outsized influence on the S&P.
Sure. So essentially, if you had an equal weighted index, it is exactly what it sounds like. Every stock essentially has the same weighting overall in that index, whereas the S&P 500 is market cap weighted. So essentially, the size of the market cap of that company determines the exposure within a portfolio. So think about a company like Apple that has over $1 trillion market cap. Very few companies have that. Sometimes they trade in and out of that $1 trillion range. I think only Microsoft and Apple have ever had that. But if you think about how big some of those companies have gotten from that perspective, that means that they take a bigger and bigger and bigger weight over time compared to another typical household name that might be a smaller weight, but nonetheless within the S&P 500. So it depends on how the weighting is done. And again, in the market cap, that essentially is determined by how big the market cap of that company is. And if you look at how those have performed, performance moves higher, and that essentially boosts that market cap as well. Earnings move higher, that boosts that market cap as well. So you can see how better performance, larger market cap, one kind of begets the other, and it becomes quite a concentrated index.
So per se, the mega cap, or what they referred to last year as the Magnificent Seven, which are basically seven of the largest companies by size, by capitalization. So those top 10 companies returned on average 62% last year, and the other 490 smaller companies returned on average only 8%. And so it really was a very, very concentrated experience last year. If you had exposure to any or all of those Magnificent Seven, or on your chart, the 10 largest companies, you had a positive experience. And if you didn't have exposure to any of those Magnificent Seven, your experience was somewhat lackluster. And so it's just important to understand where returns come from, and the difference in this case between cap weighted versus equal weighted versus the Dow Jones is something called price weighted. And so it gets a little technical, a little bit involved. And sometimes people are like, well, the market did X last year. How did you do compared to the market? And so I think it's important to be able to understand what people are saying. They might not realize or understand what they're saying when they're referring to that. Well, Meera, we just want to thank you very, very much for your time today. And Brittany for making Meera available to us. Also, Chris Scales, who is a relationship manager for us with JP Morgan. And I will tell you, Meera, that when Chris was suggesting you for our featured speaker today, he is known to, or you are known to him as his favorite CFA. So I just want you to know you are Chris's favorite CFA.
Love it. That's great.
You spending time with us today and enlightening us. And I would say that our Covenant Wealth Strategies outlook is very aligned, very similar to JP Morgan's in terms of economically not seeing a recession, seeing strong employment, seeing continued expansion of the economy, And don't know that there's a 24% upside in 2024 as there was in 2023. But certainly we see opportunity to make money for our clients. And so I think we're aligned in that way. Meera, congratulations to you on your upcoming family expansion project. And we pray that the remainder of your pregnancy and the delivery are an enjoyable experience and that mom and baby are healthy when we next have the opportunity to speak with you.
Thank you so much for the time today.
All righty. That will wrap up our January 31st Stone Barn Speaker Series virtual program, JP Morgan Guide to the Markets, Meera Pandit, Brittany Wills. Thank you all very much for joining us.